Right. No, I'm joking. Alistair's been following urea for a long time, but he left us and went to another research group and was responsible for urea market forecasting, focused really on all aspects of urea, fertilizer, urea, and other applications. And then we managed to persuade him to join us a year or two back. And he runs our fertilizer research team, and his particular area is urea. And he's genuinely the person that investors and banks and stakeholders call if they have questions about what's going on in the urea business, what does it mean for Yara stocks or CF stocks and so on. So he's a global expert on urea, and we've asked him to join us at this conference and give us an outlook on urea, especially the factors that influence and are relevant for the DEF industry here in North America. So, Alistair, the floor is yours.
Thank you, Tim. So I'm going to start off by saying that the last 18 months in the global urea market have been incredibly volatile. 2017, I suppose as Tim mentioned, I've been looking at the urea market since about 2005, 13 years now. And 2017 was probably the worst year I saw. Lowest prices when you adjust them for inflation, and just awful. I mean, in July 2017, we got prices down to $150, $160 a ton, which was incredibly extreme. And you fast forward now to the summer of 2018, and prices have more than doubled. We're looking at every day it seems now we're gaining $5 a ton. So I really want to look at what's brought around that dramatic change in the fortunes of this industry, how we can go from having CF getting absolutely hammered in the stock markets to suddenly being the analyst's darling. I guess the big answer to that question in one word is China. So there's going to be quite a China focus to this, because single-handedly that nation has completely changed the fortunes of the urea market and all of these urea producers. And ultimately it's been the biggest factor affecting the price of urea coming into NOLA, coming into the East Coast, coming into the West Coast. And ultimately that's what's driving your guys' business. That's what's driving the price of the automotive grade urea and the wholesale DEFU that's being moved. So yeah, we'll dive into that. There are a few other international factors we'll cover. Iran's a big one and a big unknown. And we'll look at the supply and demand outlook, look at what's happening, what caused, how China's had that big impact globally. So I've broken this up into four topics. I'm going to try and move through it briskly so we can maybe make some time back. Supply and demand balance is the first area we'll look at. Supply and demand really is the main driver of prices, I'm sure you're all aware. We'll look at those developments in China that have really moved things, really changed this market. We'll have a look at some wild cards and price forecasts. And I'll give you my final view on where prices are going at NOLA over the next 18 months and over the next 15 years. And then we'll close by looking at the potential for more building out more urea capacity in your market, in the US market. So my first one I've called capacity investment has slowed, but a new counter-cyclical wave is underway. It really sums up where we are. First of all, we'll look at demand. As you can see, we've had a real change in pace of demand, and that's what triggered, one of the factors that triggered the collapse in urea prices from 2013 down to the bottom in 2017. In 2012 we were looking at $500, $600 urea. Move forward to 2017, we're down to $150. One of the main drivers of that was a collapse in global consumption. So we, prior, from the late 1990s all the way through to about 2013, this industry was growing at about 3 to 4% per annum every single year. Some years we were gaining 6 million tons of new demand. The main drivers of that, of course, were China, and to a lesser extent, India and the subcontinent there. And frankly, something quite dramatic happened in 2012, 2013, and that's that both those markets ran out of steam. So, we had the end of the commodity super cycle, which was driven by a change in the structure of Chinese growth and demand. And we also had something called the environment, really, which raised its head. And that's changed, I think, the way the Chinese and the Indians are consuming urea. Both those countries dramatically overuse nitrogen, and there's been a real move to cut back and change the way they're consuming urea. So the combination of that shift in their economic growth and the realization that they can get more yield from less urea by better using that urea has really changed the way this market's functioning. And of course, in those countries, agriculture is still to an extent a command economy. The government really determines what happens in those markets, and they've said use less urea. They're rationing urea from farmers who'd otherwise keep putting more and more in, looking for incremental yield. So that's the big change that's happened on the demand side. So we see that drop there in 16 into 17. That's what really helped hammer prices. Apart from that, though, if you cut out China and you cut out India, we've actually had some very good demand growth in the US, in Europe. The US built out 5 million tons of urea capacity, and that process is finished now, although all 5 million of those tons are running and being produced in the US market. But demand levels are still looking at, demand levels grown, I think, around 1 million tons over the last 3 or 4 years for urea. From you guys in the ag side, in the industrial side and in the AGU side, but also in the agriculture side. We've had a couple of, record years for corn in the last 5 years. And despite the fact a lot of noise around soy and the improving soy-corn ratio in acres, quietly, corn growth has been increasing, and urea consumption into corn, into winter wheat up in the northern plains has also really been quite impressive in the US. And that means the US is going to import, I think, around 5 million tons this year. So, at the peak before these plants came online, the US is importing 8 million tons. This year it will import 5, even with that new 5 million tons running. So, very impressive growth in demand in the US market. Same in Europe. Same in Russia. So in those mature economies, we're seeing good growth. It's just those big developing ones that have let us down a bit with the change in their overall consumption pattern. Looking forward, 1.4% a year. So it is a slow growth from here. We're not seeing 5 or 6 million tons. We're seeing between 2.5 a year now for the next 5, unless something changes structurally. Supply additions. So the rate of supply additions has slowed. This is my forecast of net additions of dry urea capacity to the market. So this is prills and granules. If you look at 2017, that's the last year of that big wave of capacity investment that was triggered by high prices in 2012. Prior to that, 2016, 2015, we were adding between 6 and 8 million tons of new capacity to the market each year. So now we've dropped down to around 3.5. We've halved the rate of capacity additions. However, we're not seeing a fall away to those pre-building boom levels. So we've still got this residual level of building activity, and a lot of that is being driven by governments. So we've moved away from an era of high prices and prices signaling to investors that we need more urea capacity. We've moved to one now where governments are either directly building or encouraging the building of urea plants. And that's happening in a few areas: Central Asia, Azerbaijan, Turkmenistan, Kazakhstan. These guys are adding more capacity just because they've got gas going unused and they want to turn it into dollars, so they're taking it out of the ground, and they're investing counter-cyclically. All right? And then you've also got Nigeria. The government's got $1.50 gas available to anyone that wants to build a urea plant. So we're getting a lot of urea plants being built down there in Nigeria now. Nigeria is that dark green color on there. So they're one of the main drivers of capacity investment. The other driver, of course, is India. India is in the red there. The government has decided it doesn't want to import urea anymore, and it wants to build loss-making urea plants instead. So again, you're getting this counter-cyclical investment from a government doing something that wouldn't normally be accepted in commercial in a commercially driven investment model. So yeah, despite the fact that we have had this structural shift, we've still got a good base load of urea capacity coming, and that is going to put a ceiling on how fast and how quickly prices can move up over the next 5 years. I don't think we'll see prices moving back to the $500 levels that we saw, between 2007 and 2012. And it'll be because of this counter-cyclical investment. So as prices recover now, we're going to get these plants coming online that were conceived when prices were at their lowest. So what effect has that had? That slowing of demand and that investment wave. One of the features of that investment wave was a lot of it, like in the US, like in India, like in Brazil, a lot of this capacity was being built to substitute for imports in big importing markets. And as that's come online, it has had the effect of cooling trade growth. So we had, around 10 million tons of trade growth between 2010 and 2015. 2015 to 2017 has been pretty flat. The big shift is on the import side. You can see the red, like I was saying, India has decreased its consumption, and that means it's decreased its imports. Everybody else, North America's decreased a bit from 8 million down to 5, that dark green line. Everybody else is about the same or a little bit of growth. Brazil's had some growth, Turkey's had some growth. The big offset has come from the reduction in import requirement from the US and from India. If you look at the exporters, that ROW one at the top, the big one, that's all 90% of that is the Middle East. They don't report trade data, unfortunately, so it's hard for me to break it out for you, but most of that is Middle East exports. Iran and not Iran, but the Arab Gulf, the GCC countries. The big change there, of course, is, like I said, is China. If you look at 2015 down to 2018, you can see that they've gone from exporting around 15 million tons of urea, 14 to 15 million tons of urea in 2015. That's collapsed now. They'll export just 1.5 million tons this year. And it's that dramatic loss of China's competitive position, its export position in global markets, that has driven or corrected and helped us, corrected the oversupply and corrected these problems on the demand side and driven prices up and caused them to double over the last 12 months. So this is the supply and demand balance. The way this works is I've looked at events, I've looked at demand side events and supply side events that move the market towards a surplus each year or move it towards deficit each year. So capacity expansions are in the green color. They're moving the market towards oversupply. And it's those, if you look at 16 and 17 there, that 5, 6, 7 million tons of capacity addition is, that happening since 2012 is what triggered that big oversupply. And we've moved down a bit, that's cooled a bit. If you look at the events on the bottom, and the dark grey is demand events. So of course we had that demand contraction in 16 and 17. And then demand is growing now, as I said, at a rate of around 2.5 to 2.7 million tons a year. You can see demand is now on the deficit side. It's moving this market towards deficit and higher prices. A couple of other things are happening. Light grey, that's the loss of China's export position. So every ton that China doesn't export year to year, and it's closed domestically, that's helping us rebalance our market. That's good for prices. Other things that are moving the market towards deficit that are good for prices are closures. And of course, after 2017 and 2016, those low prices, we've seen closures. Brazil is closing loss-making urea plants. Kuwait has decided that the returns on urea are too low to bother with, so it's going to close its urea plant. And I think we might see one or two more unexpected closures as well over the next 18 months. The Iran export delta in there, and that's what I'm expecting the impact of the Trump administration sanctions on the Iranian economy to be in urea terms. So I'm expecting around 1 to 1.5 million tons of loss of Iran's export position. So those big, non-demand events, the loss of China, those closures, and the loss of Iran, that's really going to help move this market to net deficit and be positive for prices both this year in 2018 and next year in 2019. So, I'm expecting to see the supply and demand balance really helping push prices up. Beyond that, though, this counter-cyclical wave of investment I'm talking about, that's really going to break even, maybe slightly be on the surplus side, and there's a chance, we'll see more expansions, and I'll get to those in a minute. But yeah, I think that'll cool prices once we get into the next decade. So these are the speculative plants that are outside of our capacity forecast. Okay, so you've got a plant in Brazil that's been developed by Akron. There are some plants in India that are a little speculative. They're trying to build in a region that doesn't have any gas supply yet, so I'm doubtful that we might see those guys get built. And then we've got the Iranians. I think it's impossible for them to build these plants under sanctions. We've got a couple of speculative bits in Russia. And then, of course, we've got a few plants that are still progressing in the US, such as Midwest Fertilizer. But still, for the time being, outside of my main base case forecast, and I'll get to why. But all of those plants represent a downside risk on prices. Because if I add those to my supply forecast, we suddenly get big numbers again on the capacity addition side. So if we see those Indian plants build, it's going to be bad for prices. If we see another, I think we might, if we see another Nigerian plant start kicking off building, that's going to be really bad for prices too. A couple more opportunistic Russian plants, maybe we get one or two of those US plants built, because like I said, US is still importing $5 million tons of urea. There's a chance to put a couple more import displacing plants in there without upsetting the premium structure in the US. If we see any of that happening, that's going to start creating a problem for us with surplus capacity in about 2021, 2022. So what happened in China? These are 6 charts I think really sum up what's happening in China. If we start with the pie chart, you can see that overwhelmingly the grey sectors and then that bright green sector, that's coal. So around 75, 80% of China's installed urea capacity is based on gasifying coal. The red one is natural gas, so there's still a significant balance there that's using natural gas in China. But overwhelmingly it's coal, and you can see the relationship between urea and coal prices. Anthracite is the just about, it's the legacy one, it's the one they started on, it's very high value coal, it's very expensive. Plants that use it are quite marginal. So that means the anthracite has created a very good relationship there with urea. That's what's been driving urea pricing since 2012, 2011, when China started to oversupply the international market. Urea's been moving really in lockstep with the coal market. And as you can see, we've had a big increase in the coal market. We've had a big increase in the urea price in line with that. But that increase in coal has helped squeeze out China by making it less competitive. You can see in the next chart what's happened with the journey we've been on really with Chinese exports. They've gone from under 5 million tons in 2012 to 15 million tons in the middle of 2015, all the way down to almost 1.5 million tons by the end of this year. So they've been on a big journey. And throughout that, the government has been subsidizing this industry in China. They've been giving them cheap gas. China pays $13 to import gas at the moment, LNG, and it sells gas to urea producers for $4 to $6. When these guys have been loss-making for years, they were still exporting, they were still running at 85% because the government was giving them cheap capital. So this is a subsidized industry. So Mr. Trump's really too late with his trade tariff when it comes to urea, because he would have had a legitimate case for price dumping between 2012 and 2018. But I don't really see any way back for them. One of the main issues, actually, we're seeing this collapse in the export position from China is environmental regulations. The Chinese government has decided it doesn't want to use as much coal. It certainly doesn't want to use coal to make urea to sell to America or any of their neighbors, in fact. It doesn't want to subsidize and give cheap gas to urea that's going to be exported to the international market. So the government is forcing plants to close, forcing plants to derate. So this is a considered structural decision from China that it no longer wants to be a significant exporter of urea to the international market. The question will be, does China want to be self-sufficient in urea? I think the answer to that is yes. So I think they'll keep subsidizing gas. They'll ration it, though, and you won't see these gas plants running all year round. And finally, you can see the operating rate down here. That collapsed over the last 3 years, down from around 85% all the way down to 65%. And at the same time, we've seen that decrease in consumption. I think it will slightly grow, but we're not looking at any real increments in urea consumption like we saw between 2000 and 2015. This is the Chinese cost curve. So this is the production cost of every plant in China. We've lined them all up for you, just to show you quite how diverse Chinese urea production is in China. You've got those different feedstocks, and broadly speaking, natural gas and bituminous, so thermal coal-based producers are the cheapest, and anthracite producers are the most expensive. There's around 82 million tons of installed urea in China. China consumes 54 million tons, 55 million maybe, and it exported just 1.5 million. So there's something wrong with that sum, and that is because a lot of these plants aren't running. So these ones I've highlighted here in red, these plants have all been closed. Now the interesting thing is they're fairly evenly dispersed throughout the Chinese cost curve. And the reason for that is because most of these plants have not been closed for economic reasons. They've been closed for environmental reasons. And that's a one-way street. The government isn't going to change its mind about the environment now. It's made a decision it wants to close these. These plants are being closed. And the only real factor between these plants, or the correlation between them, is the fact they're all located close to population centres. So these are plants where cities have encroached around them, and they've been closed. So I don't think they're coming back. So when we remove those, we get a slightly different picture. There's now only 70 million tonnes. The rest is idle for those environmental reasons. And it's a much shorter cost curve. And now we start getting closer to that 55 million number. So I've stacked it up here. So you've got around 80 million tonnes of nameplate capacity this year. Had a few closures. We've got these idle plants that are idle for environmental reasons, takes us down to about 70. The age profile of China means that some of these plants are built in the 80s, the late 70s. They'll never run at 100% of their theoretical configuration. So if we adjust that down by 95 or 90%, we end up at a closer number, so around somewhere between 68 and 64 million tonnes of what I call effective capacity, plants that could actually produce. So then we have a look at the operating rates. Now the nameplate operating rate we're looking at, that 65% over the year, is in grey. The adjusted effective capacity is in red. So despite the fact it looks like China's operating rate has been very low, dropping as low as 45% in the winter when they're mandated to close even more plants for 3 or 4 months for pollution reasons, China actually can't run any harder than it's running now. And that's why prices in China's domestic market are still $300 right now, even though they're hardly exporting anything. The reason they're hardly exporting anything is because they need it all domestically. They can barely cover their own domestic requirements. Now, between October and February, China is forced to derate its plants by the government. They all have to turn down, they have to shut off a line, or they have to physically use less coal. And that happens every year. So those guys are forced down if you have a look in that chart. And this is structural, this isn't changing. So, China, I think, really is out of the picture now as a major exporter, which is good for us and good for prices. So, because of that, we're pretty bullish on prices. This is my forecast of urea in, over the next year and a half. So, right now we're in this nice little up run. We're getting some nice premiums again at NOLA. Exports are down this year. There's been big demand domestically. Some issues with a couple of turnarounds, but nothing major on the supply constraint side. People are just buying more urea, and that's helping us re-establish these premiums over Black Sea. And I'm expecting that to continue. I think it'll cool off a little bit in H1. We've got 4 or 5 new plants starting. Plant in Azerbaijan, a plant in Turkmenistan, 2 plants in India, a plant in Egypt. That new supply, it comes out to around 3 or 4 million tonnes. That should have a cooling effect, but some of those projects have been delayed. So those delays, any overrun there is going to mean higher prices into Q1. The futures markets are already pricing in, $320 urea. You can go out there and buy it now if you want. If you're confident this market's not going to soften. But yeah, it's looking bullish going forward. And again, when we get into the loss, we've lost liquidity from China. And China would normally provide the liquidity to us in Q4. It's not going to be there. And with that in mind, I'd expect to see a similar pattern next year. Over the longer term, though, I expect to see, as I mentioned, a run up to about 2020, and then I've got a cooling in mind. We've got significant new capacity coming over that period. The market will have to adapt and rationalize to it. Costs will be higher for us, though, and we'll be looking to places like Europe to be marginal cost setting. Gas in Europe is now $10 again. It's hard to see too much easing of that, and by the time in the next decade, I'd expect to see a higher cost floor. So we won't have so far to fall. And then, of course, demand should kick back in again. So this does give opportunities to build. And like I said, I would expect to see some of those speculative plants take advantage of this higher price environment to start planning and start adding in new urea plants over that 2021, 22, 23 period, which will again put a little bit more downwards pressure in that dip. The main wild card to this forecast, of course, is Iran. Like I said, I think China's one-way traffic. I don't see a way back for them. But Iran was building up its exports. And I'm expecting these sanctions will cut some of that business out for them. But that's not certain. However, if we look back in time, I've divided up these Iranian exports by destination, and I've called them sanction-sensitive business. So that's exports to Europe, Malaysia, Thailand, Indonesia, Philippines. These are countries that need to do business with the US. They need to work in dollars, and they don't want to be penalized or cut out. So they're going to pull out. They already are pulling out. And we can see under the Obama administration's sanctions between 2013 and 2017, we can see that business really, really died away. The core business is India, it's Pakistan, it's Bangladesh, it's Vietnam, Myanmar, North Korea, a real rogues gallery, really. India plus some of these countries that don't mind or don't do enough business with the US to care too much about US sanctions. I'd expect that to stay there. So that's going to be a base load, but they'll lose a lot of that sanction-sensitive business. Another thing that's been happening is rebagging. So Iran ships material to China, the Chinese stamp it Chinese and send it out. Now, Europeans, Malaysians, Thai, Philippines, they won't touch that, but the Bangladeshis will, the Indians will, the Pakistanis will. So that's still going to be in there. The only concern is that Trump, my feeling is, what I hear anecdotally, is these sanctions will be more severe. Donald Trump wants to be more severe than Obama was to Iran under the last round of sanctions. So, there could be some upside price risk from a tighter sanctions regime. But the Europeans want to save the deal, so maybe that means this won't be as bad as we think. So yeah, this really is a wild card going forward. It's too soon to tell what's going to happen. What we do know has happened so far is that the Indians have struggled to pay Iran for the urea they bought in August. That still hasn't been paid for 2 months later. They can't pay for it in dollars. The UAE doesn't want to be a reserve currency like it was last time. And then the cost, so for an non-Iranian flag vessel to pick up in Iran, costs have doubled for that trade. So if you're moving material from Iran to China in a non-Iranian vessel, 2 weeks ago you would have been paying $30, $35 for that journey. Now you're paying $75, $80 for that journey. So there's real barriers now on this trade, even amongst the guys who want to do business with Iran to spite America. So the last point I want to look at is why, we're in the US now, why am I not including any US capacity in my base case forecast? And the US market still has strong bona fides. I had a nice chart I was going to have in here of a map, based on Tim's one where I had all the urea plants and then I had the urea coming in, but it was on a corrupted thumb drive and I couldn't get it off in time. But like I said, still importing, despite that build out of 5 million tons, they're still importing 4.5 to 5 million tons of urea this year. It's all running. This is the baseline we're going to have. It'll fluctuate with demand, of course, but I think between 4 and 5 million tons a year of import still in the US, so you can displace it. Gas prices in the US, I put Canada on here as well because it's North American as well. Gas prices are still, $3. That's been the only stable thing in the world, really, in the world I'm looking at, has been the Henry Hub gas price. If you go inland, you go into the interior and Midwest, you'll probably pay less than $3 because there's some interesting gas surpluses in those regions. And the rest of the world generally, is much more expensive. Europe's got even more expensive now. It's up at like $10 instead of $7.50. Really it's only the governments in the Middle East who can, offer cheaper gas prices than the US or Nigeria. So you've either got to be a government to build at that price, or you've got to be willing to deal with building in Nigeria. So again, that's a strong reason to build in the US. Main reason is CapEx. Capital cost of building in the US has got incredibly expensive. I've found the price of some old builds, so I think it was the original PCS, or Arcadian it was at the time, Augusta, maybe Borga was in there, and I can't remember who in the 1990s, but these are plants that were built that I could dig out from the annals of history how much their CapEx was. I've then adjusted that with an MUV deflator. It's a manufacturing unit value deflator to put it onto a real basis. And because the configurations of plants have changed, there's an UAN, there's AGU, there's granulation. When back at the beginning it was just urea prills. I've put it onto a dollars per ton of nitrogen, but these are all ammonia urea trains. Okay, so the main takeaway is that capacity intensity in the US has expanded dramatically over that period. The most recent one, that's CF Donaldsonville and OCI Iowa, those kind of guys building. So plants have got bigger, okay? So they're more expensive to build. They're building different high-value products, so that's more complicated manufacturing. They've got more efficient, gas consumption is more efficient on ammonia. That's more complexity on that ammonia process. So that's one reason why things have become more expensive. And in that way, you're trading off a CapEx against having lower operating costs, which, to some extent makes sense. And the other, but one of the main drivers, of course, is the expense of construction labor. The US is the most expensive place to build a nitrogen plant in the world. Maybe Canada, a little bit more expensive, or Australia. But it is up in that top tier of expensive places to build in the world, and construction labor is a big part of why. It's expensive to build on the Gulf Coast. It's more expensive when you've got to get 2,000 guys to go and live in, the Canadian Plains or in Iowa. It's much more expensive, and that creates a real hurdle now. So if you want to build a plant, 70-30 in favor of financing, you've got to find almost $1 billion of equity finance to get this plant going. So one thing people look at doing, of course, is smaller plants. So you lose some of the capital efficiency, your capital intensity increases, but that hurdle rate of equity is much lower. The other thing is that prices are still low, I think. When I look at why I include a project in my forecast, I look at its economic costs. I put an example here. So I consider the economic costs to be the OPEX of the plant, so the cost of running it plus some fixed operating costs. I consider it to be the value in use. When I say value in use, I mean that a plant in the US Midwest gets a much better price for all of its products than a plant in Odessa or a plant in Egypt. Okay, it's in its market. So this is an attempt to capture the premium that's available to US producers and put it on an even benchmark with everyone else. So if you see the premium there, I've got, it's a 65, right? The last 2 years it's been around average $65 a ton premium over FOB Black Sea. There's some freight across the Atlantic, and then there's the cost of moving material down into the Midwest. This is for a Midwest build, really. Gas price, conservatively at $3. Total OPEX, on that basis, at around $125 a ton. CapEx, $2.8 billion. It's at the high end, but as I said, the configuration here is for a 3,500 ton per day urea plant, making 1.3 million tons a year of urea. Economic life for 25 years. Weighted average cost of capital on the build of 9%. That's cost of debt and cost of equity. And that gives us an opportunity cost on what else they could have done with that capital. And a tax charge of $28 because we're looking at returns to investors through dividends that come post-tax. So if we add, A is the OPEX, B is the capital servicing. So the capital servicing is the $2.8 billion over 1.3 million tons a year. We charge an interest rate at the WACC. and we've amortized that over, or annuitized it over 25 years, and that gives us that value of $219 a tonne. So that $219 a tonne pays back the principal of the build, and it pays back the debt holders the interest rate they wanted on the loans, and it also pays back the equity holders their cost of capital, their minimum hurdle rate they would expect to get back from this project. So that's all in there, and the tax charge, as I said, because we're looking at post-tax returns, that gives us an economic cost of $317. And right now, on a Black Sea basis, because we've adjusted it to Black Sea with that premium adjustment, so right now, this project, if it was running, it would be profitable in cash terms, very profitable in cash terms, but it wouldn't be returning with urea prices in that current $260, $270 a tonne range we've had over the last year. This plant wouldn't return value to shareholders. It would destroy it. So that's a consideration, I think, when you're looking at financing it. The prices, although I think they'll get there, they're not quite that attractive at the moment when you're looking at financing such a big capital spend. I did a little heat map. So looking at the economic returns with prices, it's overlaid, I don't know why, but on the first heat map is with prices at $270 at Black Sea, and the next heat map is with prices at $350. So two very different pictures. When you're in the green, you're getting a really good IRR on that plant. You're getting a really decent NPV. When you're in the red and the orange, it's questionable. So, as long as you can persuade your investors that you think you can get to the $350 per tonne level, the market's going to take us there, then you can start seeing all that green. And of course, that's 350 tonnes really on a kind of real basis, so we're still a little way away from that. Still why I think we've seen that slow down in building. The access to capital is difficult now with the combination of capex and urea prices where they have been. Urea prices have been increasing. I doubt we'll see much downwards movement on capex, but if you can cut the size of your build, maybe you can cut the size of your initial capex, and that might make it more attractive. And another reason, of course, is that other places are building. Like I said, Nigeria, we did the same exercise with Nigeria, same exercise with India. The Nigerian guys, even with today's low prices, they're getting a good, positive NPVs, positive, really good IRRs. India, they don't care. They're making a loss now. They're making an even bigger loss in the future when LNG prices increase. But they're still building because the government wants to build loss-making plants because it'd rather do that than import urea from Iran. That's the issue, is that those two building models we're seeing, the government building model and then the kind of rent-seeking building model in Nigeria, where you have very, very cheap gas. This could crowd out investment in the US by countercyclically adding in new capacity when we would expect prices to be reaching that $350 level that would make that US build look good. So that's my concern about adding more plants to America. So that's the end of my presentation. In conclusion, I think the urea market looks to be in deficit. I can't spell deficit, but it looks like it's going to be in deficit for the next 2 to 3 years, which is really good for prices, until India and Nigeria complete their building and they cool that price runoff. China should remain supportive of higher prices. It's withdrawn all of its liquidity. Prices will rise until 21, 22, and Iran, I think the rate of that rise is going to be determined by what happens with Iran and America. We might have a new administration. We might not in 2021, 22. So we could have lots of liquidity from Iran or none. And then US building, there's potential there. I can see the bona fides look good. CapEx is the problem. Our smaller builds the answer. So that's the end of my presentation. Thanks very much for your attention, and I hope it was useful and inspired some thoughts in you. Thank you.